Hello guys, welcome to our channel. In this video, we will be talking about the classification of the stock market and the segments present in it. So if you like the content, hit the like button and subscribe to our channel. So let us talk about the classification of stock market. Basically, Indian stock market is classified into two types of market. One is primary market, another one is secondary market. Okay, we'll go into the details. Now the examples that come under the primary market are IPO and FPO, initial public offering and follow-on public offering. The second thing, secondary market, the segments that come under secondary market are equity and derivatives. Now let us go deep and understand what is a primary market. See, a primary market is a financial marketplace where a company or government issues shares or securities or bonds for the first time for the investor to buy in. Okay, so considering that, now let us ask what is IPO. IPO is nothing but initial public offer. How does this initial public offer works? Let us say there is a company, the promoters of that company wants to raise money for various reasons. Let us say they want to clear debts, they want working capital, or else let us say they want to hire new people. Okay, they need a certain amount. What they do is that they take their demand, they go to the regulatory body, that is SEBI, and they ask a certain price for it. SEBI then evaluates its documentation and then presents the shares for the public to buy for the first time. This is called as initial public offering. There would be a different offering price, there will be a different listing price, right? It depends upon the demand, how much the IPO has been subscribed or oversubscribed. Okay. Now next, let us ask what is FPO. FPO is nothing but follow-on public offer. This takes place when the company which is already listed in the stock market wants to issue more number of shares in the market. That means it wants to raise more money in the market and it wants to sell out a even more greater percentage of its company to the public for the public to buy. For example, the investors to buy in it. Okay, so this is FPO. Now let us talk about secondary market. Secondary market is a marketplace where investors or traders buy and sell shares of the already listed company in the stock exchange. For example, there is a company which has been listed that has to come through IPO. Okay, and after the IPO, the stocks of this company start to trade in the market by investors or traders. They buy and sell these stocks here. So that is called as secondary market. Now, let us consider the segments that come under secondary market. The first one is nothing but equity. Equity, also known as cash or spot market, right? Here, what happens is that you buy and sell securities at the same place, at the same time, at the market price, whatever it is running over the counter. The transactions are immediately settled and the transaction gets exchanged immediately at the market price, whatever it is trading over the counter at the marketplace. The second thing is derivatives. Derivatives are nothing but a contract or a set of contracts that has been derived from an underlying asset. Okay, underlying asset, especially it is equity only, it has been derived from this. For example, I'll give you an example. Let us say there is a lemon, right? Lemon is nothing but equity and lemon juice derived from this lemon is called is lemon juice. Now this lemon juice becomes the derivative product of the lemon. So let us say if the prices of lemon goes up, definitely the prices of lemon juice will also go up. If the prices of the lemon goes down, definitely the prices of the lemon juice comes down. So that is derivative market. Equity is nothing but cash market or spot market. Derivatives in India, we have futures and options. So these are the segments that come under the classification and the hierarchy of the market in Indian stock market to trade or to invest for a investor or a trader. Now that we have talked about the equity and the derivatives, let us differentiate them. What is the differentiation between equity and derivatives? So, right. So in equity market, the first thing is cash and the other thing is derivatives. That is nothing but F and O. Okay, so it's futures and options. In Indian market, we have only two derivatives, whereas in other markets, there will be swaps and some other products also. Now, let us see what is the differentiation between cash and futures and options. What are the main characteristics of this product that is available in stock market? So, first one, cash, futures, options. The first main differentiation is any number of shares. That means in cash, you can buy any number of shares given on your investment. If you want to buy one share, you can buy one share. If you want to buy 10 shares, you can buy 10 shares. If you want to buy 99 shares, you can buy 99 shares also. Okay, it depends upon the investment. Whereas in futures and options, that is the derivatives, the buying is done based on lot size. Now, what is a lot size? Lot size is nothing but a fixed number of shares set by the operator or the stock exchange, right? So, for example, Bank Nifty is the index options. Okay, let us consider a stock, Reliance. Okay, the lot size of Reliance is 250. Right, that means if you want to buy one lot of futures in one lot of Reliance in futures, you have to buy 250 shares of Reliance. Okay, second thing, if you want to buy more, then your second option is 2 lots, that is nothing but 500 shares. So the lot size will be fixed. Depending on that lot size, you need to accumulate, or you need to invest, or you need to buy your preferred stock or shares. Same thing in options also. Now the second thing is carry forward. This means if you buy a share in stocks, in cash, you can carry forward your investment for any period of time. That means you can keep it for 1 day, 2 days, 3 days, 1 year, and even 10 years. Still, you want to hold that investment. There is no expiry. You can keep these shares or the stocks you bought in cash for as long as you want to keep it. The second thing in derivatives is that there will be a expiry. That means the contract will expire. In futures there will be a monthly expiry which expires on every end of the Thursday of the month. The last Thursday of the month the contract expires. In options, in stock options there will be monthly expiry. In index options there will be weekly expiry as well as monthly expiry. That means you cannot keep your investment or your position after the expiry. You have to sell it, or you have to close your position before the expiry. The third thing is that you can only buy and carry forward your position in cash. That means you cannot sell and keep your position on hold. Selling is available only for intraday, which we call as short selling. Okay, only for intraday you can sell your position, but you have to clear it before the closing of the market, right? But in futures you can buy and as well as sell. And in options there is another scenario. You can buy and sell both call option and put option, right? So these are the difference. These are the main difference that is present in the segments of the stock market, that is cash and the derivatives, futures and options. Okay. Now in this video we have discussed the classification of the stock market, the different segments present in the stock market, and the different differentiation between the segments in the stock market. If you like the content, subscribe to our channel.